Welcome to XM.com. You're watching the Daily Market Comment for Monday, February 20th by Mario Sachikiriakos. I'm Christina Marukos. A series of powerful economic data releases out of the United States this month dispelled concerns about an economic slowdown, engineering a massive repricing of Fed policy. Market participants pushed up the expected peak in Fed rates to a new cycle high of 5.3% and priced out most of the rate cuts that were anticipated later this year. This repricing helped propel U.S. yields higher, with the one-year U.S. Treasury bill now yielding 5%. Yet the dollar's advance was not impressive, barely gaining any ground against the euro or pound. It is an ominous sign when a currency cannot rally on good news, although in this case the sluggishness might reflect the cheerful mood in stock markets instead of outright pessimism towards the dollar. The real victim of the Fed pricing and the resulting spike in yields has been the yen, which continues to be shackled down by the Bank of Japan's strategy that enforces a ceiling on domestic yields. Since the central bank does not allow longer-dated Japanese yields to trade above 0.5%, the yen mechanically weakens whenever foreign yields edge higher, as rate differentials widen against it. However, with Japanese wage growth firing up and inflation already hot, there is growing speculation the Bank of Japan might raise the yield ceiling again next month. Such a move would alleviate some of the pressure on the yen. Gold prices have also been feeling the heat of rising yields. Bullion now has to compete with a risk-free rate of 5% on short-term Treasury bills, which has siphoned demand away from the precious metal that pays no interest to hold. That said, the Chinese central bank continued to raise its gold reserves in January, making it difficult to be bearish on gold while there are such whales active in the market. Shares on Wall Street had a volatile session on Friday, with indices like the S&P 500 erasing some early losses to close nearly unchanged. That said, the fundamentals are not very encouraging. Valuations remain expensive, with the S&P 500 trading above 18 times this year's estimated earnings in an environment where earnings growth has turned negative and yields are marching higher. That's a dangerous cocktail for equities. Thank you for watching today's Daily Market Comment here at XM.com.